Good evening, everybody. Myself Shankanath Bandokotha on behalf of Informatics. I wish a very warm welcome to all of you. Now, today I am just going to discuss, the current implications of the RBI Repo Rate hike. And so, as all of you are aware that on 4th May 2022, the RBI hiked repo rate from 4 to 4.4%, 40% hike by 40 basis points. Now, while the rate hike was strongly expected amid global and domestic inflationary pressure, the timing of hike is a little bit surprising for the market, and it was quite unexpected as market was expecting the hike in the June monetary policy. But now it is believed that RBI is probably trying to create a space for further rate hike in June 2022, probably by another 35 basis points. And given the high inflation, even the April inflation reading is quite high, and in line of the US also 8.3%, now in India also 7.79 CPI is quite high. So amid this inflation surge, the RBI has also thought that it should even it has been criticized for a long time that is behind the curve, so it has increased the repo rate by 40 basis points on that line. So now interestingly, that it's also is synchronized with the Fed rate hike by 50 basis points, whereas Fed has created space for a rate hike in the range of 0.75 to 1%, which is the target range for the federal funds rate, and Fed anticipates that ongoing increases in the target range will be appropriate. Additionally, Fed has decided to begin reducing its holding of treasury securities and agency debt and agency mortgage-backed securities on 1st June, as described in the plans for reducing the size of the Federal Reserve balance sheet. Now, many central banks have increased the policy rates in recent time. So, amid surging inflationary pressures, we have seen the Bank of England has increased bank rate by 0.25 percentage points to 1% in a majority voting, and on 13th April 22, the Bank of Canada also increased its target rate for the overnight rate to 1%. With the bank rate at 1 and 25% and the deposit rate at 1%. So the bank will begin the quantitative tightening effective 25th April 22. The maturing Government of Canada bonds on the bank's balance sheet will no longer be replaced, and as a result, the size of the balance sheet will decline over time. On 12th April 22, the Central Bank of New Zealand also raised the interest rates by 50 basis points to 1.50%, its fourth hike in a row, as it seeks to reduce second-round effects from sharply rising inflation. The risk of more persistent high inflation expectations has also increased, and the committee agreed that their policy path of least regret is to increase the official cash rate by more now rather than later to head off rising inflation expectations and minimize any unnecessary volatility in output interest rates and exchange rates in future. Now, coming back to the RBI repo rate hike, we can say that interestingly, if we see that what exactly now is happening is the reverse of what happened during the 7th February 2019 to May 2020. Now, that point of time, RBI is on a rate cut mood. So say for instance, on 7th February 2019, the repo rate was 6.25%. On 4th April 2019, it was reduced to 6%, and on 6th June 2019, it was 5.75%. And on 7th August 2019, it was 5.40%. On 4th October, it was 5.15%, and it remained same on 5th December 2019 as well as on 6th February 2020. Now, on 27 March 2020, it was further reduced to 4.40% before settling at 4% on 22 May 2020. Since then, it remained status quo, no up, no down, until 4th May 2022 before the recent repo rate hike at 4.40. Before that, it was at 4% level. Now, after RBI raised 4.40%, it is exactly a reverse path that was followed from May 22 to March 2020, and during those days the mantra for policy rate was largely like The MPC notes that output gap remains negative and the domestic economy is facing headwinds. The need is to strengthen domestic growth impulse by spurring private investment, which has remained sluggish. Against on June 2019 policy, it stated that MPC notes that growth impulse have weakened significantly as reflected in a further widening of the output gap compared to April 2019 policy. Now RBI, even if you see that in December 2021 the RBI's tone was a bit dovish to some extent. The MPC noted the supply side measures taken by the government to contain food prices, as also the calibrated reduction in central excise duties and state VAT on petrol and diesel. The crude oil prices also softened since end November. That was actually the tone of in December 2021 RBI policy, and according to the MPC, such developments should ease the domestic cost push build up to some extent. Now further, if we see the February 2022 monetary policy, that stated that the MPC note that inflation is likely to moderate in the first half of 2022-23 and move closer to the target rate thereafter, providing room to remain accommodative. Though it is acknowledged that potential pickup of input cost is a contingent risk, especially if international crude oil prices remain elevated. Now such dovish tone was changed abruptly in the April 2022 monetary policy as concerns over protracted supply disruptions have rattled global commodity and financial markets, given the significant share of the two economies, that is Russia and Ukraine, engage in war in global production. Now, as RBI has recently hiked the repo rate to 4.40%, that we have by 40 basis points. Also, the cash reserve ratio, that is CRR, that is also raised by 50 basis points to 4.50%, which is likely to withdraw liquidity of the order of 87,000 crore with immediate effect. Now, basically, this is a liquid, cash to the total reserves that is maintained by the commercial banks, and as per their NDTL, that is net demand and time liabilities, and this increase of the CRR has a very direct effect on absorbing liquidity, and it's very quick effect of the absorbing liquidity. So in a way, that is a very effective measures to absorb the liquidity that has been pumped up over the years, and the hike has indicated the RBI's intention to control liquidity at a much sharper pace. In fact, RBI's introduction of the SDF, that is Standing Deposit Facility, and previous policy tone is also in line with the intent of absorbing huge surplus liquidity. Now, average surplus liquidity in the banking system, which is reflected in total absorptions to SDF and variable reverse repo rate auctions, amounted to 7.5 lakh crore during 8th April to 29th April 2022. In fact, the operating target, that is the weighted average call money rate, remained below the SDF due to the large liquidity overhang in the form of daily surplus funds parked under the SDF, which is the SDF currently is 4.15%. Just it has been increased from 3.75% earlier, and this weighted average call money rate is in the range of 3.65%. So even that indicates a very interesting thing, that even the weighted average call money rate is below the SDF. That means there is ample liquidity, and this now RBI is in a mood to basically absorb, because it is believed that this excess liquidity is also pumping up or injecting some of the amount of inflation in the system. Now, what are the market impact of the RBI repo rate hike? So let us see that as it is been increased by 40 bps and the CRR increase of the 50 bps has shaken up the bond market to some extent, as the intermediate increase becomes a surprise. Immediately after the rate hike, the BSE Sensex crash of the 1300 points, and certain bonds, say for instance, that is giving the yield of the 6.54% maturing in 2032, ended at an yield of 7.38%. Now 10-year GSEC is up 27 bps at 7.38 to the 7.40% in the range, and it is likely to go up a little bit further, it is expected. The INR was at 76.41 to the dollar against 76.52 in previous sessions. The yield surge has impacted also the debt mutual funds, even in some mutual funds and in some asset category to certain extent negatively for obvious reasons. And the foreign portfolio investors also sold shares worth 2075 crore. DIs were the buyers around the 2 to 9 crore, and APS pulled in 6,400 crore from the equity market in the first 4 trading sessions in May 22. May 2020. Now, API flows are likely to be volatile for this said reasons now, and the rate hike is also the market might factor as 35 to 40 bps further hike in June policy, and this will be tough for all assets. And 10-year benchmark yield could move up further. It can be expected. Now, as a fallout of the increase in this repo rate, and also there are some upward pressures on the lending and deposit rates. Many banks have increased their external benchmark based lending rate, and banks also face upward pressure on their deposit rates. So, including we have seen that ICICI Bank, PNB, and Bank of India, Bank of Baroda, and many other banks have raised the repo linked lending rate with effect from 9th May 2022 for new customers and from 1st June for all existing customers. Even central bank has hiked between 10 to 40 basis points, and there are also some banks whose loans are linked to the benchmark. The MCLR based loans are restricted to 10 bps across tenors. HDFC also Limited has raised their real prime lending rate on housing loans, and which its adjustable rate home loans are benchmarked by 30 basis points. And since NBFCs use the prime lending rates costlier than repo linked rates charged by banks, so there might be some refinancing or repricing attempted by customers, but some loan balance transfer may entail higher costs, processing fees, legal and mortgage decision fees. But such refinancing makes sense when the rate hike is large, say more than 50 basis points. For NBFCs also, borrowing costs is likely to increase. Now, rupee felt also the downward pressure as it reached lowest at 77.5 to USD as the dollar index gained strength due to a combination of factors. Strong dollar index supported by Fed rate hike. No market surprise by Fed. I mean, Fed has already made it clear that we are going to hike the rate. So it is very clear communications to the market. Unlike the RBI that have certain ramifications on market, the 10-year US Treasury crossed 3%. Equity market remained nervous. I mean, record API close. Domestic bond market seeing surge in 10-year benchmark bond, that also we have highlighted. Higher US interest rates with policy stability might have a pull factor by FIS from the emerging markets, including India, which is the reason for the weakening rupee. There is also some downward downtrend of the RBI's forex reserves that declined below 600 billion, which also shows that RBI is intervening the forex market to stabilize rupee's value vis-a-vis USD. In fact, RBI is sold almost 30 billion or 30 to 35 billion forex reserves just to stabilize the rupee's value. And as the dollar index has gained strongly after the US Fed rate hike, so also this is a major factors for the declining of the rupee. Now, while both Fed and RBI has been criticized as behind the curve amid surging inflation, RBI has surprised the market in respect of timing, while Fed is following whatever it had indicated to the market earlier. Inflation now is a complex issue, as we all know, but sometimes it is coming through food supply channels, onions, edible oils, energy. More worryingly, inflationary expectations are high. Even if we see the recent RBI household inflation expectation survey, we have seen the inflation expectations have increased in all the categories. Say, for instance, food inflation, non-food inflation, overall inflation have increased expectations. And in housing and cost of housing also. So in services category also, the inflation expectations has increased a lot. So so actually, if policies are credible and well timed, so that will help in containing the inflation expectations. As this will be a clear communications to the market, which is, however, is this time is a little bit absent in case of the RBI's policy. Probably they were expecting that inflation will be contained going forward, but unfortunately this did not happen because of the Russia and Ukraine war, the geopolitical issues, a lot of supply chain disruptions as well. Now, increasing repo rate is basically a demand control measure. We have seen that if it is being increased, then there is a impact on the housing loans and auto loans and even kind of mortgage and kind of your EMIs and all will be going up. So it is basically is a kind of a demand compressing measures. But for addressing supply side issue, there are two aspects: factors that are under control of the government and external factors that are not under the control of the government. So for instance, that is happening due to the global developments, that is global commodity inflation, supply chain disruptions, semiconductor issue, energy issue, oil and gas issues, and lack of many crucial raw materials emanating from geopolitical aspects. So internally we can pursue certain policies that are under the control of the government, and to ensure that for any policy mistake the problem should not propagate further. And now lastly, that RBI estimates the degree of anchoring by shock and level anchoring. As we know that shock anchoring is basically implies the transitory supply side shocks and inflation surprises, but is the difference between the realized inflation and prior inflation expectations that do not affect inflation expectations of economic agents. On the other hand, the level anchoring assesses directly whether inflation expectations are anchored at the inflation target. Now, based on this, an empirical analysis is undertaken for 4 quarters ahead of inflation expectations. It might happen that RBI may revise inflation projections going forward in the before the June policy, even the June policy. But communicating effectively to market will give confidence to the market and economy, especially when household inflation expectations are drifting higher. So on this note, we are concluding this, and thank you so much.